Get Rich Education is brought to you by Norada Real Estate and Ridge Lending Group.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Hey, welcome to GRE, Get Rich Education, episode 71. I'm your host, Keith Weinhold, back to help you never live below your means, but rather use the same efforts that you would have used there to instead expand your means. Thanks for tuning in. I really appreciate you. Today we're talking about the big picture with astoundingly experienced and articulate author, speaker, and economist, Daniel Amerman. What's happening in the national and global world of finance affects you as an investor, and especially if you're a real estate investor with loans. But these are the kinds of concepts that, you just don't think about every day. So for today's show, I thought, who can I find that can make these complex global monetary concepts simple for you and at the same time related to real estate investors? And Daniel Amerman is that person, because he's also experienced as a professional real estate investing analyst. So I'm the one that specifically sought out today's guest for this show. It wasn't the other way around. And, it's really the first time we've had a macroeconomist on GRE since Richard Duncan way back in episode 7. You know what you're going to see today that you probably don't see on other episodes? Okay, you're going to see me as a student in the classroom with you. I'm going into the classroom as a student today. I guess I'm used to people looking to me as a real estate investing educator, but, with global monetary policy, I'm probably more of a student, so you're definitely going to see me be, vulnerable and transparent, and a couple times I think you'll kind of feel me learning right along with you today as I talk to Daniel Amerman. I mean, every one of us is a student to most things in life, really. Today, I asked our guest if over the next 10 years we're headed for inflation or deflation, and you know what? I got an answer that I never expected to hear, and I learned something in the process. We'll discuss the CPI, the Consumer Price Index. That's the U.S. government's faulty and almost always understated measure of inflation. And when we talk about inflation here, we mean the diluted purchasing power of a dollar over time. You know what else? Now, I'm not trying to be a pessimist here with this, but I'm going to ask our guest, Daniel Amerman, about what some of the triggers are to look for in the broader economy that might signal a housing crash. At one point today, I asked Daniel a question that makes him respond that this is one of the most important questions that you could possibly ask. So it made me feel like an engaged student, I guess. This is the kind of show where you likely want to download it rather than stream it because it's the type of show where repetition is really where you learn. You know what else? Just a couple things real quick that are going to enhance your listening experiences over the long term. When you download an episode, what takes up space on your phone or listening device is not the number of minutes in the episode. Okay, the number of minutes in an episode doesn't determine the space it's taken up. Rather, it is the number of megabytes. Get Rich Education has an excellent sound engineer and editor. He's one and the same person. He smartly compresses the audio file so that our episodes take up fewer megabytes per listener minute than most shows. So, for example, a downloaded 40-minute GRE episode takes up less space on your phone than a 40-minute downloaded episode for most other shows. Something else that makes the GRE listener experience better is that we're one of the very few shows in the industry that has show notes accompanying every episode that timestamp each topic within each episode. So, for example, if you want to go back 4 episodes ago to find out about rental vacancy rates in the Atlanta market, you'll see that we discussed that topic at the 21-minute, 42-second mark. Those timestamps are right there in the show notes for you. You can typically find an episode's show notes on your podcatcher. For example, in iTunes, While the episode's playing and you're in the view where the large GRE logo is shown, you just tap on the GRE logo, and right there are the show notes, complete with timestamps. And there are a lot of useful hot links in the show notes there for you too. So when you download an episode, it consumes less bandwidth on your device. And you also have the show notes for reference for all time there, so you can easily refer back to things. So that's enough on helping your user experience today. Let's pull back now and look at the big picture and how that affects you. Our next guest is a chartered financial analyst, author, and speaker with an MBA in finance and over 30 years of professional financial experience. He's the creator of a lot of financial media, including 2 books published by McGraw-Hill. He's been a speaker and a workshop leader for sponsors including the Institute for International Research, New York University, and many banking groups. And, one big reason that he's with me today is because he's been an outspoken critic of conventional retirement planning, arguing that the accepted paradigm has deep, fatal flaws that could lead to millions of retirees becoming vastly disappointed at how retirement looks for them. He's been dissatisfied with the conventional choices for investors, so our guest has spent a lot of time researching concerns like financial crisis, inflation taxes. Listeners, you know how I've called inflation the invisible tax. And he's also steeped himself deeply in the study of economic growth rates. So welcome to Get Rich Education, Daniel Amerman.
Thank you, Keith. Thanks for having me.
Well, Daniel, here we are in 2016. That kind of puts the U.S. here 7 years into, I guess, a so-called recovery commandeered by the Fed. So what's really happened in this time is that the wealthy have been getting wealthier, the poor have gotten poorer. So do you see us continuing to be on that course now?
Yes, I think the chances get steadily greater that we are going to continue down that course. We do have a number of challenges coming at us in terms of we have an aging society with an ever greater number of retirees. We have a falling ratio of people who are currently working to retirees. We have a heavily indebted federal government. And if you look to the Congressional Budget Office numbers that just came out yesterday, it looks like that's getting ready to accelerate again with ever greater entitlement spending. And when you put all those together, we have an economically challenging environment. And this can be very difficult for investors because it enables the redistribution of wealth from those who don't really fully understand what's going on to those who do fully understand what's going on. And I would argue that has quite a bit with why we have seen such a divergence in recent years is because it has been such a challenging environment that the usual financial education doesn't show the solutions.
One way that you've characterized as to what's really going on and what's happening with the Fed plan is really something, I guess, politically clandestine that you've termed financial repression. What's going on in society with the government is financial repression. What is financial repression?
Just to be real clear, it's not my term. It is and there's nothing controversial about it. It is a fundamental macroeconomics concept that has played a key role in societies around the world, particularly the United States, for decades and even centuries. The general way to look at financial repression is we have a cycle that goes back and forth in economies. And again, this is completely accepted in terms of economics, between cycles of financial liberalization and financial repression. And financial liberalization is a cycle where the free markets have an ever greater role. Financial repression is where government dominance over markets has an ever greater role. And for instance, if you look at the aftermath of World War II, we were kind of like where we are right now. Many other things are completely different, but the total national debt was approximately the size of the national economy. So the United States went through about a 25-year cycle of financial repression that will probably be ancient history to most people who, let's say, in their 20s or 30s or early 40s or something. People are a little bit older are going to have some memories of it. There are a time when interest rates were controlled as a matter of law. There were capital controls. You couldn't own precious metals for investment purposes and so forth. That all went away from about the early 1970s to about the financial crisis of 2008. And we went through this period of financial liberalization. And of course, it's like anything else. If we're seeing this our entire life, most people don't think there's any other alternative.
Right.
But when the financial system got into big, bad trouble back in 2008, the economists at places like the Federal Reserve, like the United States Treasury, like their equivalents in other nations, very quickly, in a period of about 2 years, most of them were back in play by 2010, brought out this whole bag of tools that they had from the 1940s, 50s, and 60s that have the elements of what we call financial repression.
So there is actually some precedent for what's going on then, or?
Absolutely. Yes. The U.S. government went from about 1947 to the mid-1970s from having a debt outstanding that was roughly equal to the national economy to a national debt that was under 30% of the national economy. And there was nothing fortuitous or accidental or lucky about it. It was a very carefully planned process. And we're seeing many of these controls in somewhat different forms that have come back to us in recent years. And if you want to understand why interest rates have been so persistently low, let me suggest that we need to understand financial repression to understand why. Because there's another much more specific usage of the term financial repression by economists, and that is, how do countries get out of these staggering debts?
Yeah, there are a few different ways that they can do that, probably 3 or 4 different ways, most of them pretty politically unpopular.
Yes, that's absolutely true. First two that people understand, because they think about national governments as being like, let's say, their own households or something like that. The first alternative would be default. People who don't really understand that the economics are involved, this seems like the most logical thing. You just reach the point where you can't pay your debts anymore. It's a little bit different when you control your own currency like the federal government does. Another alternative, and this has been very popular or unpopular, depending on who you talk to, in Europe has been austerity. And that is where you lower expenditures and you raise taxes and you try to close the gap. And again, that's like a household. You have a deficit going down there, so you cut what you spend, you increase what you take in, and that kind of covers the difference. And what default and austerity have in common is that everybody understands them. And they are politically very unpopular.
Right.
If you're a politician, it's a good way to get out of office. Now, there is a third alternative that we could call I don't mean to be disrespectful here because they're wonderful people in many ways, but the Argentinian option. They're one of the best known examples. Germany's been that way in the past. Some other countries have been that way. And that's where you create a high enough rate of inflation where you can pay back the money in full, but because the currency you're paying back, and in this case would be the U.S. dollar, is worth so much less than it was at the time that you borrowed it, you're able to get out of deep debts by that method. But there's a problem with a high rate of inflation, and that is, again, the general population, meaning the general voter, understands it, and it can be politically very unpopular. Now, there's this fourth method, and again, I didn't come up with this in any way, shape, or form. This has been there for many decades, and this is actually the most popular way for governments to get out of deep national debts that we have seen in the last century. The United States, Britain, France, Japan, Italy, Australia. It's what everybody did coming out of World War II when all these nations had these very high debts from having paid for it. And what you do is that you create this artificial differential that we see around us all the time right now. Anytime you go down to your bank, you see it. Anytime you're looking at what you can get in a money market fund, you see it. And what happens is that the interest rates that the government pays on its debts are very deliberately held beneath the rate of inflation. And this can be a little bit of a hard concept to wrap your mind around. I've got several illustrated tutorials on it on my website, danielamerman.com. But essentially, it's a slow process. And because it's going on a fairly slow basis, even though everyone feels the pain, they know they're not getting those interest earnings, they know their savings aren't building and compounding the way they're supposed to, they don't understand that there's always two sides of a transaction, and where the benefit from their very low interest rates and their interest rates being below the rate of inflation are going is on an entirely deliberate basis to the national government that's trying to reduce the national debt.
The real rate of inflation, and we can talk about what we think that really is, but the way that decimates savers and the way it does it, it does it 20 to 50 fold. If you want to consider inflation as high as 5%, which I sort of still think is realistic, that's 50 times the rate of what a saver is getting in a money market fund or a savings account at 1/10 of 1%.
Yes, I think you have multiple levels that you can look at here. One of them is the official government rate of inflation, which I would argue is very different from if we look at an individual rate of inflation for most people. I think there's certainly a strong case to be made that the real rate of inflation, when we look at things like healthcare, housing costs, other things like that, is much more in the 4, 5, 6% range. And then we're having a quite major ongoing annual transfer of wealth from the average person who doesn't necessarily understand what's going on to the federal government, to sophisticated investors, and if they do it right, to real estate investors.
Yeah, absolutely. We've talked a lot about how there's really not just an inflation hedging benefit, but probably an inflation profiting benefit when you tie up long-term fixed interest rate debt. You're doing that for 3 decades, typically, when you're leveraged with cash flowing real estate in a good market. And maybe I can just get your opinion on this, what you think. I truly believe inflation could still be a 5%, even now when the CPI is shown to be pretty close to flat or almost down to zero. There are a few deflationary forces out there. What's going on in energy is certainly deflationary, as is globalization. But, over on the inflationary side, come on, we all know healthcare costs, education costs, the costs of food are all rising significantly. And oftentimes those sectors aren't weighted appropriately. They're diminished in their weighting in the calculation of the CPI.
Well, particularly for someone who, let's say, is self-employed and is aware of what's been happening with health insurance premiums. Compare on the one hand how much money you're saving because the price of gas has dropped so low. Compare that, on the other hand, to what has happened to the cost of your healthcare premiums on a monthly basis by themselves over, let's say, the last 5 or 10 years. And then when you particularly take into account, assuming you have to actually see a doctor once or twice, and you're running into the rapidly rising deductibles. I mean, there's just no comparison. I think for the average American, the increase in their healthcare cost far outweighs any benefit from a lower cost of energy. As just one example.
Sure. Yeah, I don't think it's offsetting that at all. So inflation is pretty important, since you've listed inflation or hyperinflation as one of the alternatives to go ahead and get rid of our national debt. When you look at this bigger picture, okay, in the United States, we control our own currency. We have the reserve currency of the world. Some ask, well, what is the problem? Why can't we just be in debt forever and get into ever greater debt? How is that really going to catch up to us?
Well, there are major issues when it comes to debt, and some long-term studies have been done. I think the most recent one was from a couple of Harvard professors, Reinhardt and Rajoff, several years ago. And what they did was they looked at multiple nations over a period of centuries, and they compared growth rates in those nations between nations that were heavily in debt and nations that had much lower levels of national debt. And the national growth rates are substantially higher for nations that there's a substantially higher natural private enterprise growth rate if you have a lower level of government debt. Because the problem is, when you have a government level of debt that is as high as it is right now in the United States, the whole economy gets distorted around paying for that debt and trying to control that debt. And sadly, that is a dysfunctional environment for the creation of private wealth using the usual methods.
What are some examples of that? I mean, where does that debt begin to weigh us down as an economy? Where does that begin to trickle in first? Where does that manifest itself?
Well, the first place that it manifests itself, and I do have an article, it's currently my most current article on this. Can a nation that's $18 trillion in debt afford higher interest rates, and will this change our retirements? And the issue is that when we look at interest rates, they're in some ways almost a zero-sum game. What benefits savers hurts borrowers. What hurts borrowers benefits savers. And in this case, because the United States government is so massively in debt, the key to keeping deficits as low as they have been, or at least the official deficits, has been driving interest rates down to the level where savers are getting almost no returns. And that is on a day-by-day basis, changing the standard of living and the retirement plans for tens of millions of people in the United States right now. If you have someone who had worked for decades to accumulate, let's say, $500,000 in savings, and they were really thinking that would bring in $25,000 a year in interest income to supplement their Social Security, and they're getting maybe $2,500 a year in interest income now, if that, unless they're taking big risks, that's changing their standard of living day by day. Someone who is following conventional retirement planning and they thought they're going to be able to compound that money by, let's say, 4, 5, 6% per year, which would allow them to retire at age 65, let's say, and then they're counting on that interest income. Well, now they're looking at a retirement at, let's say, age 75, if then, and the income they would earn is much lower. So there's this very direct, very personal effect on all these tens of millions of dollars from the substantial amount of government debt outstanding. And then now, what's the other thing that happens here? Well, that is all these different people have all this consumption and spending that they were planning on doing that they can't do anymore. So what happens to the people who want to sell houses to them? What happens to the people who want to rent to them? What happens to the people who want to sell cars to them? What happens to the people who are depending on their going out to a restaurant and enjoying a nice evening with a steak and bottle of wine? All that spending is not happening because of the very high level of government debt as part of a cycle of financial repression.
If savers are effectively losers, I am a big borrower, and I've advocated on my show for some reasons as why one might want to be a borrower, because effectively when you borrow at long-term fixed interest rate debt, when you have effectively a rental tenant also paying down that debt for you, so you've outsourced your debt service to somebody, and you've been able to basically take dollars from the future and bring them into a present, being a borrower is kind of the antithesis of being a saver.
Particularly when you have a cash flow that's rising at close to the real rate of inflation. I'm sure you saw in the last few weeks the estimate came out that for multifamily units in the United States, that rents were up something in the range of 4.5%.
Yep, it's really been a good time to be a long-term fixed interest rate debt, a leveraged investor in cash flowing real estate. You're listening to Get Rich Education. When Daniel and I come back, we're going to talk about some potential triggers of a housing crash and how does the average person respond to all of this that's going on in the economy that has a job, a family, a 401k, and does some real estate investing. This is Get Rich Education. I'm your host, Keith Weinhold. Would you like to be able to finance up to 35 income properties and all with one lender? Ridge Lending Group specializes in investment property loans, and they do it in almost every U.S. state. Ridge has worked with tens of thousands of real estate investors and homeowners all over the country. And check this out. At this point, they've helped more families realize their dreams of becoming real estate investors than any other mortgage lender in the country. To find out more, visit ridgelendinggroup.com.
Are you looking for a roadmap to financial freedom? If so, we have a solution for you. Norada Real Estate is offering a limited number of free strategy sessions to help you get out of the rat race. Learn how you can create wealth and build monthly passive income. To set up a time with one of our knowledgeable investment counselors, simply go to noradarealestate.com. That's NORADA realestate.com.
This is David Campbell from Hassle-Free Cash Flow Investing. Listen to Get Rich Education with Keith Weinhold, and don't quit your daydream.
Welcome back to Get Rich Education. So Daniel Amerman is my guest, and we're talking quite a bit about inflation versus deflation because that's a really significant consideration for one that has long-term fixed interest rate debt. We've got gold out there, which that in itself sure doesn't seem to foretell of any future inflation. So where do you think we're going, Daniel, over the next 10 years as far as inflation versus deflation? And why does that matter to a real estate investor?
This is one of the most important questions you could possibly ask for people to understand. And when I hear inflation versus deflation, my response has to be wrong question, because the correct answer is both inflation and deflation.
Both.
Yes, that is crucial for the economy. That is crucial for real estate investment in particular. And I've got a lot of writings that are devoted and tutorials that are devoted to this subject. The issue is we really have two different things. One of them is the price of assets and investments, let's say, and another one is the purchasing power of money. And whenever people say it is inflation versus deflation, which, let's face it, the average person doesn't think about either one very much.
No.
Not unless something's really out of line.
That's why I call inflation the invisible tax.
Yep. And for someone who is reasonably economically literate, they read some financial pages and so forth, they think there's this big overwhelming issue is, will it be inflation or will it be deflation? And if we look back at history, if we look at recent history, and if we look at past challenged financial times, the answer is often both. And let me give you an example here. Let's say that we start off with an asset. Let's call it a rental house.
Okay.
For round numbers, it starts off and it is worth $100,000. And 5 years from now, you sell it for $200,000. Was that inflation or deflation?
Well, just based on that, it could very well be inflation.
You would think so. You go from 100,000 to 200,000. And if you're limiting yourself to either inflation or deflation, the answer has to be inflation. You've doubled in price.
Sure.
Now, let's say that during that same time period, there was a bout of inflation. And just for round numbers, we say that a dollar became worth 25 cents. Now, is that inflation or deflation?
You now have more dollars, but you have diminished prosperity.
You have a diminished purchasing power for your property. Because if you have a $200,000 property and a dollar is worth 25 cents, then what's the real purchasing power of that property?
$50K.
$50K. It gives people headaches to think about this sometimes. A little hard to wrap your mind about. But we've seen examples of this many, many times through history. And what has happened here is that a high rate of inflation when it comes to reducing the value of money has produced the illusion of a profit in that rental house. If we're looking at purchasing power only, it looks like we've doubled our money from $100,000 to $200,000. But in fact, we've gone from a purchasing power of $100,000 down to $50,000. So we have monetary inflation. And there's different definitions, but I'm just using the simplest one here, which is basically saying a change in the purchasing power of money has entirely covered a loss in the purchasing power of the asset. And this is actually quite routine for things like the stock market. For decades, we can have newspaper headlines saying the Dow Jones is higher, the S&P 500 is higher. And it looks like we have this continuous bull market going on for a long time until you step back and you adjust for inflation. And then you see we may have decades of real reductions in the purchasing power of, let's say, stocks being hidden by a greater destruction in the purchasing power of money, which produces entirely real taxable profits. That's what inflation taxes are,
right?
That you're taxed upon, even though you don't have a gain in any sense. And if we look at an environment that we're in right now, where we have a challenged economy, we have many assets have been pushed artificially high because of the Federal Reserve's policy of creating this ultra cheap money, which has created asset bubbles. And that combination, and we also have a federal government that badly needs inflation to generate not only tax revenues, but a reduction in the real value of the national debt relative to the economy. Well, then if we look at the fundamental asset side, what we're seeing is we have a strong case for deflation in the years ahead. And it may get stronger still as ever more baby boomers enter retirement or are selling their investment assets. But at the very same time, we have a monetary inflation, and I don't mean this in terms of money supply, I mean this in terms of purchasing power, that's going the exact opposite direction. And we have this pervasive illusion of it looks like everything's gaining in value, but it's actually losing value, even while it's generating increased capital gains taxes for the government the entire time.
That's a good point. And back to the example of the $100,000 property appreciating to 200K in nominal dollars over 5 years. Of course, if that investor is leveraged, that same inflation went ahead and ate away at their debt. If on that $100,000 home, they had 80K in mortgage debt,
Right.
well, that 80K over 5 years is reduced to 20K of effective debt. So there's an advantage there for the leverage investor. I want to point that out for the listeners.
Yeah, I've got a free book on that very subject, as well as some other matters as well. I really think that for real estate investors, this is absolutely critical information. How asset liability management works in combination with simultaneous deflation and inflation.
Okay, so if you think there's more of a prospect, I don't want to put words in your mouth, tell me if I'm wrong. If you think there's more of a prospect over the next 10 years of there being deflation rather than inflation, I mean, could that really hurt the leveraged real estate investor? Could that even be one of the triggers of a potential housing crash?
Everything's relative, and it depends on your safety margins. I spent many years financing real estate in terms of multifamily properties and bond issues that were financing real estate and so forth. And I guess that makes me a bit of a specialist, but I really don't like the word leverage because it's so general. It kind of sounds like you're just going for one technique. When I think about borrowing as part of asset liability management, I see it as being like a musical instrument. You can get almost any tune you want out of it. It's not simply a matter of leverage. The issue that you're talking about, a lot depends on the market, of course, and it depends the specific path we're going down. I think there is a strong case in inflation-adjusted terms that we're more likely to see deflation than inflation, and most of the sophisticated investors in the world are kind of in agreement on that over the next 5 to 10 years. They're seeing that as being a greater danger. However, there's this illusion that people think it's inflation versus deflation, and then they think that somehow, because it's got to be one or the other, that the likelihood that investment assets are going to lose value somehow protects the value of their money. Like you can't have inflation with the value of their money. And history would indicate that we're probably going to have both. Now, the issue then is which is greater. And again, if you want to take a real estate market perspective, I think that becomes very local and very market dependent. I believe that the chances of a true crash are much higher in some of our higher valued areas right now, increasingly back in California. We're seeing it again in Florida. We're seeing it in New York City. That's for sure. We're seeing it. I don't know how many Canadian listeners you have, places like Vancouver and Toronto, Sydney in Australia, and so forth. We're all seeing it there. I think those people are actually at substantially greater risk than if we're looking at, call it a place I like very much, it's where I like to live, flyover country, where the valuations have not gotten nearly as high.
That's perfect. We focus quite a bit on buying out-of-market properties in flyover country, the heartland, the Midwest, and parts of the South where you do have relatively low purchase prices and you have relatively high rent incomes to those lower purchase prices.
Substantially higher capitalization ratios are available, yes.
And you typically have landlord-tenant laws that are more friendly and a whole bunch of things. But getting back to deflation a little bit, if that's I don't know if I want to make it sound overly ominous, but if deflation is a specter on the horizon, you think the Fed will jump in and do something to try to control us from going into deflation? Because basically the government has what I believe to be an inflationary mandate over the long term.
Well, they do. And of course, there's measures like understanding. Again, it just comes back. This is so critical. But it's not part of a high school education. It's not part of Economics 101, typically speaking. But it comes down to a matter of understanding how you have simultaneous asset deflation and monetary inflation. That's one of the most powerful tools that a central bank like the Federal Reserve has, is to create a rate of inflation over time that's at least somewhat higher than the asset deflation that's being offset. Because as long as that is happening and people don't understand it, they don't understand the losses they're taking, and they don't change their behavior in the very dysfunctional ways they might during an open, let's say, 5 years or decade of real asset deflation.
Yeah, I'm still just trying to get my head into this asset deflation at the same time that one has monetary inflation. Sort of a new paradigm for me, but it's starting to sink in and make sense. Is part of the reason we might have monetary inflation in tandem with asset deflation, is that because the banks have a lot of excess reserves, a lot of excess liquidity parked at the Fed because that's where they get a safe return. As soon as that comes off the bank's balance sheets and comes out into society to people, to borrowers like me, is that going to accelerate monetary inflation?
Oh, you're really opening a can of worms there, Keith, which I find to be a fascinating one. I'll just hit a highlight or two there very briefly. People talk about printing money, and many people have wondered how the Fed could, quote unquote, print $4 trillion in money without creating inflation.
Right.
Or $2.5 trillion and so forth. And again, this kind of stuff, it's not controversial. You can find speeches about it all over the place, but it's from one economist to other sets of economists. And Benjamin S. Bernanke explained this in detail back in 2009, 2010. What the economists are doing is they're using something that's called sterilization. It's not an accident. And I've got charts, again, in several of my key articles on my website that show the almost dollar for dollar match or 100 billion for 100 billion match, whatever you want to look at it, between the growth on the balance sheet of the Federal Reserve's holding of U.S. government debt. The Federal Reserve now holds about 13% of the total national debt of the United States, and the growth of what are called excess asset reserves. And what an excess asset reserve is pure monetary creation. There's no physical bill being printed. There's no literal printing there. You'd probably burn out a printing press trying to keep up. But what they do is they create new money out of the nothingness, and they give that to a bank to purchase the U.S. Treasuries, or let's say agency mortgage securities or something like that. And then the bank is given strong incentives to hold their assets at the Federal Reserve. So if you want to know why this extraordinary amount of monetary creation did not trigger high rates of inflation, that was entirely intentional. It was the Federal Reserve policy, as explained in advance by Bernanke and many others since that time, that they were basically assuring the capital markets that they were going to basically put these trillions of dollars in kind of a corral and keep it in there and keep it from escaping so it wouldn't trigger a high rate of inflation. Now, the really interesting part is that if you go beyond the press releases and you say, well, what if the Federal Reserve really wants to create inflation? How do they do it? They start to let those balances go out.
Yeah.
It's been there the entire time. They're not there by accident. It's carefully constructed. And if they do want to really pick up the overall rate of monetary inflation, that's exactly how they can do it. Or price inflation.
5 years ago, you had a lot of people predicting monetary inflation by the time we reached this point, and it sounds like that's a big reason why we haven't seen it.
Correct. And I did have a series of tutorials explaining this on my website in 2011, but most people don't understand that.
Well, as we're kind of winding down, Daniel, a lot of time on Get Rich Education, I think we spend time down on the ground, in the forest, where the trees are, walking through the trees, climbing over a fallen tree, whacking some weeds, whatever. We're here with you today to kind of pull up and see the entire forest on a plan view, on a wide map view. So macroeconomically, do you see any other triggers of a potential housing crash?
I think the biggest trigger is the obvious one. It can certainly happen. Whether it will happen or not, I don't think any of us know right now. If the Federal Reserve loses control. I mean, we've got two basic scenarios here. One of them is if they just plain screw up. And there's actually a pretty pervasive history of their doing that. You know, if you look at where the financial crisis came from in the first place, or where the real estate bubble came from in the first place, I would argue those were each the results of misguided Federal Reserve policies. But the other issue is we could have something very bad come out of Asia, Europe, both, recession in the United States. There's all sorts of places this could come from. And to a large extent, well, they have very powerful tools. The biggest tool of all that the Federal Reserve has is credibility. And if you lose that tool, it's very hard to get it back sometimes. So I would say that the Federal Reserve losing control over interest rates, which could send interest rates rapidly upwards, would do, number one, awful things to the national debt, federal budget, deficit, all that kind of stuff immediately. And it could also trigger a major sell-off in real estate. But on the other hand, The financial survival of the United States at this point, at least with a currency worth anything like it is right now, is arguably dependent on the Federal Reserve keeping control. So what you're doing when you follow an investment strategy that's based on the maintenance of low interest rates is you're actually aligning your interests with both the U.S. Treasury and the Federal Reserve, which means they're going to be twisting everything they can around to send money to you.
All right, well, that ties in really nicely. What does the average person do to respond to all this, whether that's being a leveraged real estate investor or not? What's the average person do? The person that has a full-time job, they have a family, a 401k, and maybe a couple turnkey real estate investments. What's the best thing for them to do?
Education.
Yeah.
Basic education. I mean, on the one hand, I hate to say it because someone like that is going to be busy enough where they really don't have the time to do this.
Right.
But on the other hand, we are in a challenging world right now. And if you look at what is being fed to you through the usual media sources, mainstream media, financial media, whatever the case is, I don't think the information is there to protect yourself with the years that are coming up. So there is no substitute to learning and finding out how to better do some things.
Yeah, the mainstream media sure isn't giving it to you, but one way my listeners can get it is to check out your resources, Daniel. How can my listeners find out more about you?
Just go to my website, DanielAmerman.com. I've got a whole bunch of free resources that they can just kind of click around, just click on a graphic or something, read some articles if you're interested. If you find what you're reading to be worthwhile and interesting, I do have a free book they can sign up for that will be delivered to them via email.
All right, that's great. DanielAmerman.com. That's AMERMAN. Daniel Amerman, thank you so much for coming onto the show and giving us some fresh macroeconomic perspective today.
Thanks a lot, Keith. I appreciate your having me.
Well, great. Some big picture takeaways from Daniel Amerman. With Daniel wrapping up by saying that the Fed is going to be twisting everything around that they possibly can to send money to you, I mean, that speaks to the inflationary mandate that the U.S. government has to inflate away the weight of their debt. Well, that also inflates away the weight of your debt as a leveraged real estate investor. The tenant payments reduce your debt in a real sense, and at the same time, inflation does this for you in a nominal sense. Historically, your positive rental cash flow rises at a rate faster than inflation when you have fixed interest rate debt. If you don't know how, you can see me explain this. I do it in a 4-minute whiteboard video, which is still pinned to the top of our Get Rich Education Facebook page. So just go to our GRE Facebook page, and that video is pinned to the top of the news feed. Between the inflationary mandate and people always needing a place to live, I still don't see any better place to be than in cash flowing income real estate in job growth markets with competent management, all tied to long-term fixed interest rate debt. I send those specific opportunities straight to you as well when you're subscribed to our newsletter at GetRichEducation.com. Special thanks to Daniel Amerman today. Next week, I'm going to be coming to you from Miami, Florida, as I prepare for the upcoming Real Estate Guys Investor Summit at Sea Cruise, where I'll be setting sail with Robert Kiyosaki, G. Edward Griffin, and more, and we'll be off to Cozumel, Jamaica, the Cayman Islands, and the Bahamas. On that show, my guests and I will be talking about the best ways to manage your property manager. And if you previously weren't sure about using Property Manager or how to best manage that relationship, or you want to know how to avoid overpaying for property management services in ways that you haven't previously thought of, then next week's episode is going to help you ensure that your manager is communicative with you and profitable for you. Down the road, Rich Dad Advisor Tom Wheelwright is scheduled to return to the show once again. Until then, I'm your host, Keith Weinhold. Don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing. If you enjoyed the show, please take a minute to visit iTunes and leave your comments.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.